It's Wednesday, July 1st. Let's break down what's happening in Korea's financial sector. Our objective today is really evaluating how three unresolved regulatory fault lines impact your institution's Korea compliance exposure.
Exactly. We're keeping a strictly, system-level perspective today.
Yeah.
Because we really need to look at how retail loan surges, corporate capital limits, and, delayed crypto licensing are all interacting.
Right.
They're creating some serious compliance risks for domestic institutions.
Yeah, so let's start with the retail side, and specifically a massive number, 11.3 trillion won, which is roughly 8.1 billion US dollars.
Right. And the crucial fact behind that number is that it represents the Bogeumjari state-backed mortgage lending that was dispersed just between January and May.
Wow, just in 5 months?
Yeah, just 5 months. So they've already burned through like 57% of their 20 trillion won annual target.
Which brings us to the context, because this is where the math really just breaks down.
Mm-hmm.
That represents a 77.6% year-on-year surge.
It is.
But the Financial Services Commission, the FSC, has a standing directive to actually cut policy lending share from 30% down to 20% of total household credit.
Right.
So it's basically like trying to drain a swimming pool while someone else has a fire hose running full blast into the deep end. I mean, how can the FSC realistically enforce a 20% target without just drastically tightening eligibility?
Well, they really can't, not without causing an immediate shock to the housing market. The structural issue is that these government-backed mortgages are incredibly attractive right now.
Yeah.
So without a harsh enforcement mechanism forcing banks to reject applicants, that 20% target is entirely at odds with reality.
And because they can't just turn off the tap, this severe retail capital strain perfectly mirrors the institutional lending bottlenecks we're seeing.
Oh, absolutely. It's testing domestic banks across the board. Let's look at the industrial capital gap, specifically subjects like Samsung Electronics and Stay Hynix.
Heavyweights, right.
Exactly. The action we're seeing is they are committing to massive domestic investments. But these commitments are exposing the strict limits of domestic bank capital caps.
Yeah, and the numbers here are almost hard to comprehend. We're talking about 4,755 trillion won. That's about 3.4 trillion US dollars.
It's a massive sum.
Right. That is literally 16 times Korea's total 2025 domestic corporate bond and equity issuance. So I have to ask, isn't the math here just impossible?
Pretty much.
Take Gwangju Bank, for example. They have a 25% single borrower cap, which restricts their loan exposure to just 613 billion won, or about 438 million US dollars.
Yeah.
But they're looking at an 800 trillion won regional cluster.
Yeah, it's a huge disparity.
So are large-scale syndicated loans just fundamentally unworkable right now without a formal government financing roadmap?
Fundamentally, yes, that's the core bottleneck. Single borrower caps exist for a reason, to prevent a bank from failing if one massive client defaults. But with national-scale tech infrastructure demands, those protective caps act as a chokehold. Domestic institutions simply cannot provide long-term capital at that scale.
So because domestic regulated markets lack the capacity to meet this demand, capital inevitably flows toward highly leveraged, unregulated offshore alternatives.
Which leads us directly to the crypto regulatory gap. The proposed policy right now is conditional domestic licensing.
Right, meaning Binance Korea needs to establish a local legal entity.
Yeah, a local entity, strict AML compliance, and they have to completely restrict derivative products.
But the effect of this being in limbo is crazy. Without that license, a regulatory gap pushes Korean investors toward unapproved products. I mean, we're seeing 546 million US dollars in 24-hour volume on 150x leveraged KOSPI 3x perpetual futures.
150 times leverage on a major index is wild, and the timing here is the crucial factor. Binance's re-entry review has been pending for over 2.5 years.
Okay, wait, I have to push back on that. 2.5 years isn't just bureaucratic friction. Is this extended regulatory stall effectively a deliberate choice?
It definitely acts like one. Regulators are probably terrified of officially sanctioning that level of retail volatility.
But doesn't that deliberate stall just expose domestic institutions to massive indirect compliance risks anyway?
Absolutely. While retail investors are using offshore platforms, that capital eventually flows back into the Korean banking system. So domestic entities catch all the downstream AML fallout.
Right. So with the Bogeumjari program already clearing that 57% mark, the FSC must enforce strict caps, meaning today's moves definitively tighten liquidity conditions for financial institutions.
Exactly. The structural inability to fund these massive won and U.S. dollar industrial pipelines pushes unmitigated demand toward unregulated offshore platforms.
As the second half of 2026 demands formal regulatory action, you have to ask, will new enforcement mechanisms finally resolve these capital limits, or will unresolved #KOSPI derivative gaps continue to threaten your institutional compliance profile?